Good morning, everyone. This is the next webinar in our series of the wealth space. Our topic for today is investment properties. My name is Kelly Kennedy. I am a director and wealth advisor here at BDO in our Sydney office. There are over 2 million investment property owners in Australia, so no wonder this is a very popular topic. As a wealth advisor, my role is not to advise on specific properties, but rather to help clients with questions they've got around this topic and help them navigate their options and decipher where it may or may not fit into their overall plans. I am joined today by my colleague Elina McKerrell. Do you want to introduce yourself, Elina?
Hello all, I'm Elina. I'm a business services partner here in Sydney and I work closely with Kelly together working on clients to help with navigating complex decisions, and property investments is a space where I see both opportunity and challenges. I'm really looking forward to today's discussion with Kelly, where we'll explore how investment properties can fit into a broader wealth strategy and share insights that can help make informed choices. Over to you, Kelly.
Thank you. Okay, before we get started, we would like to do an acknowledgement that we are hosting this webinar on the land of the Gadigal people of the Eora Nation, the traditional custodians of this land, and pay our respects to their elders, both past and present. We also acknowledge the traditional custodians of the various lands on which you all join us from today, and pay our respects to all Aboriginal and Torres Strait Islander people joining us online. A little bit of housekeeping. Just want to draw your attention to the housekeeping slide that's currently showing on your screen. So to start, you're all automatically muted. We will hold questions until the end of the webinar, just in case we run out of time. You can submit them during the session. Just there's a question tab on the right-hand side. We'll try to get to, if we get time, we'll try to get through as many questions as we can. But if we don't get time, or if we think maybe too specific for the session, we will contact you after the webinar. So if you're experiencing any technical difficulties throughout, there's a support button on the bottom tab of your screen. And just so everyone's aware, the session is being recorded. All registrants will receive a follow-up email with the slides, a link to the recording, and access to other webinars in the series, and contact details for Elina and myself. Also, being a financial advisor, you need to give a general advice warning. So the information discussed today is general in nature. It doesn't take into account your personal circumstances, and it does not constitute legal or financial advice. But we're here if you would like to get some advice, so please feel free to reach out. Over to you, Elina.
So today's agenda, we'll be discussing a few items: key reasons clients consider investing in property, how the property fits into an overall wealth strategy, the roles of the various professionals. There's a few different to cover there. Types of investment properties, depreciation, negative gearing versus positive gearing, benefits of investment properties, the drawbacks of investment properties. And we'll run through a few case studies where we'll give some explanation and breakdown of how the negative gearing scenarios work. And we'll just cover off some key takeaways as well. Next slide, please, Kelly. Thank you. So key reasons clients consider investing in property. A large contributor to why people consider investing is because, unlike shares or crypto, property is a physical asset, and people sometimes feel a bit more of a sense of security. It's something that they can see, feel, stand on. There are some key benefits and key reasons, such as wealth creation in the form of capital growth. So owning an investment property, if it's in a positive position, it can grow from a capital perspective. Australian property markets, especially in cities like Sydney, Melbourne and Brisbane, have historically shown long-term price appreciation. Now, each city and market is different from the other, so they all need to be considered on their own merits with their own particular application applied. Capital growth can specifically and significantly increase wealth over time. There are income generations, so ongoing rental income can help cover mortgage repayments and provide passive income. The passive income component of it's often quite different depending on whether you've got a significant loan balance or not, but it has a income generation perspective there. Strong demand in urban areas can lead to low vacancy rates and steady income. Tax benefits, investors may be eligible, so negatively gearing, claiming losses against taxable income. Depreciation, deductions on buildings and fittings, and this is what we'll cover a bit more in a lot more detail. It is a non-cash expense, but you can claim benefit up front and throughout the holding period. And capital gains tax discounts if the property is held for over 12 months. It is a discount applicable to other assets as well, but it certainly applies to investment properties also. Pass over to you, Kelly.
Yeah. Thanks, Elina. So property, and here we're just going to quickly cover off how it fits into an overall wealth strategy. So as we discussed in the previous slide, so property can be a way to generate passive income and generate some capital growth. I think a big perspective is the capital growth side. A lot of people want to take advantage of. From a financial advice perspective, investment properties are generally better off as part of the wealth accumulation phase rather than the retirement or wealth preservation phase of life. And I think we'll cover some of why that is later in the session when we talk about the benefits and drawbacks of investment properties. So I think when considering your overall wealth strategy, you need to think about what stage of life you're at. A couple of the aspects we'll touch on later are things like cash flow, the associated tax benefits. We also need to factor into an overall wealth strategy things like, and a very common question or a common discussion I've had with clients over the years is, do I invest in superannuation or do I invest in property? And that's actually not really an either or, because property is an investment you can invest in via your super. So here what I'm trying to say is superannuation is a structure, a tax structure, and there are numerous things that you can invest in this tax structure. So we need to separate the tax structure from the underlying investment. Elina, I think you wanted to add something at this point.
So thanks, Kelly. So just with relation to the structures, there are a number of different structures that investments can be held in, specifically property investments. I think it's important to consider the type of property, whether it's residential, commercial, what the purpose of owning it is. So what the long-term strategy around that is. Is it upfront negative gearing for a residential property? Is it a long-term holding strategy? Is it a commercial shopfront, etc., where they have different risks? So the different properties have different risks associated with the ownership. And based on the particular risk and the particular property, it's quite individual as to the most appropriate structure. But there are a number of structures that property can be held in, including your personal names, superannuation, as Kelly's touched on, companies. There would need to be various planning around held in a company, and trusts. We do put a big consideration as to consideration of this when at the outset talking about from an advisory perspective, what's the most appropriate strategy.
Thanks, Lena. And I think that also comes back to your stage of life. What stage of life you're in will help to determine, as part of your overall strategy, what is the right entity for me to house my investments in. So it's a bigger picture discussion to have. There's also a consideration around, is it property versus shares? So a lot of people have sort of come to the view that it's one or the other, but it ideally should be a little bit of both. It doesn't need to be either. Each have their own strengths and weaknesses, and because of that, they actually probably complement each other and serve different roles. So, as part of a broadly diversified investment portfolio, we would think that it would be prudent to consider both. And then another consideration as part of your plan needs to be the exit strategy. So a lot of clients don't think about this going in, and there are tax implications when you do come to sell a property. So it's good to think about that going in. What is your time frame? What is your plan for how long you want to hold it? But then, um, how will you manage the tax implications? So we see it as an opportunity when clients come to us with their strategies. For me specifically, the opportunity is around the retirement planning side. So if you're close to retirement and you want to sell your investment property, you are going to realize a capital gains tax liability. Specifically, if you hold it in your personal name, a strategy we often consider for clients is in the same financial year that you sell the property, do we consider making some super contributions to help boost your retirement wealth, but also help you to legitimately minimize your tax without breaking any tax rules. But for a client, there was a particular client we did this for a few years ago. They weren't aware of the strategy that we recommended, but we saved them over $30,000 in tax by doing this strategy, which is a really great outcome for them. And then part of the longer term strategy / exit strategy needs to be at what point do we need the liquidity of these investments? Do we need the income to provide a retirement income? And is it going to be sufficient? As we'll talk about later in the drawbacks, you realize that you can't sell a part of an investment property or a part of a property that is, so you can't sell the bathroom. So if we're not getting enough income or we don't have tenants, we're going to have a period where we don't have enough money coming in to fund our lifestyle. So we just need to think about that as part of the overall plan. And then just on that point before about the options, so shares versus property, our approach is to have a diversified investment portfolio. So I thought it just might be useful to drop this in here, the historical performance of the various investment and the asset classes. So asset classes just being the different buckets that you can invest in. So direct property, and this is obviously very subjective and it can change very much depending on individual properties. There are markets within markets and each property is unique, but this just on average, you can see Australian listed shares, international listed shares overall have performed better in the longer term. But just something to add to the mix of your thoughts here. Okay, so now we're just going to have a chat about the roles of the various professionals. We're going to start with a financial advisor. So this is where a person who helps you plan and manage your finances, your wealth creation plans. We look at super, investments, insurance. My area specifically is around retirement planning. A financial advisor is not able to recommend specific investment properties. We can just take the general idea of them and talk to you about them. So that's a really important consideration when you're dealing with a financial advisor. And I guess they generally end up helping you they'll be the project manager, I guess, the glue that keeps all the different roles and takes that holistic view. Did you want to talk about your role, Elina?
Yes, thanks, Kelly. And similarly to what Kelly's just said there about an advisor not able to advise on a specific property, so also us accountants and tax agents, we cannot advise on specific properties as well. Either our role is focused around the tax and compliance, the financial reporting, the business and financial personal management, including cash flow analysis and forecasts, which you'll see in the case study. We prepare quite a lot of those. I work through in quite a lot of detail with my clients. over a period of time with relation to that as well. And similarly, as a financial advisor, we do tend to kind of keep, depends on the relationship a client might have with an advisor or an accountant, but we kind of tend to keep the glue together as well, and suggest a different professional to talk to at the different cycles and where it's needed. But yeah, ours, where Kelly's is long-term financial planning, ours is more dealing with the facts and figures and reports and the compliance pieces around all of that.
And I'd say it's probably not an either or. It's probably a good idea to have both roles working for you and with you. And then there'll be another of other professionals, such as a mortgage broker, who will help you with the lending aspects. They'll look at your borrowing capacity, serviceability. Um, they probably won't advise on specific properties either, but they'll help you with the lending side, take you to it. They'll look at a panel of lenders and hopefully get you the best loan possible and the best rate possible. Then we've got real estate agents and buyer's agents. I think that most people would know what a real estate agent is. Someone that sell properties. A lot of people, because you go through a real estate agent to buy a property, there can be some confusion. But it's really important just to really highlight that a real estate agent is on the seller's side of the transaction. They're advocating for the person selling a property. And then a buyer's agent, their role is actually to help you on the buyer side, so they can help you negotiate. They'll help you with auction techniques. So they're definitely on the buyer side of the transaction. And then we just wanted to really highlight something about property promoters and property spruikers. So it's just something to be aware of. There are people out there that they're trying to sell a property investment system, or they're involved in marketing specific property developments. You might even see them doing wealth creation seminars, getting you to come along or promoting, here's how you can do an investment through your self-managed super fund. And then they promote self-managed super funds, but they're not necessarily taking into account your personal goals and objectives, your situation. So you just need to be wary. You need to make sure you do your own research and be aware that a lot of these people do use high pressure sales tactics. So yes, beware.
Yeah,
Did you want to add anything to that, Elina?
yeah. Just they it, the property spruikers are quite different to the buyer's agents. So there are some good buyer's agents out there who will sit down with you and get a gauge of what you're looking for, what your plan is, what your strategy is. They won't prepare it for you. And nor should they. It's just then out of the back of your strategy to go out and source the most appropriate property for you in an appropriate jurisdiction. Whereas with the property spruikers, they do tend to, it's about a development. Now that development in itself might not be the most appropriate investment for you at that particular point in time, for various and numbers of reasons. Potentially there could particularly be, but the purpose of what they're trying to at times do is sell that project. A new building is being built with 1,000 apartments, and they're tasked with selling a percentage of those apartments. So there will be some high pressure tactics. They will be suggesting super funds, and yes, whilst a super fund may be in the right at the right time in life where the plan is as such could be an investment, it is not necessarily just a thing to go and do because there's an available property.
Yeah. So you need to look at sometimes how these people are incentivized and who they're referring you to. So they might say, this is an idea and you need to go and speak to X person. But then you look into the detail and realize they're getting a kickback. And maybe that's not necessarily always bad. Referral partnerships are not necessarily bad. It's just you need to be aware and do your research and make sure that at the end of the day, you are making an informed decision.
Yeah.
Okay, so we'll briefly cover different types of investment properties. I've put them into 3 buckets. We've got residential. These are the ones we're probably the most familiar with: houses, townhouses, duplexes, and apartments. So as I'm sure many people are aware, with their house, you own the land. General rule of thumb: land appreciates in value, but the dwelling is what depreciates over time. With houses, you do need to fork out for the maintenance. So houses are harder to purchase in terms of the capital outlay, and then you've got the ongoing maintenance, and that can be expensive. Apartments can be more affordable entry point, and there is potential for them to generate a higher return than houses. Depends on location. And so if you're in an area with strong demand, busy city, busy beach locations, you could potentially get a stronger return for a 2-bedroom apartment than you could for a 2-bedroom house. But with apartments, you need to be mindful that you've got strata fees, and they can be quite high. Some unit blocks have facilities, they've got a lift, they've got a gym or a pool. You could be buying into a building with lots of facilities, and that's going to cost you more in the strata fees. Then we've got commercial and industrial. So a lot of people, investment properties, they just think of it in terms of a house or an apartment, but there are other ways as well. So commercial and industrial. So there are ways to get into owning office buildings, retail spaces, medical centres, hotels, warehouses. There's a vast range available. And then other options available, we've got real estate investment trusts and managed funds. So these are probably not considered when people think, oh, I want to invest in property. They probably don't come to mind as one of the first options, but they are very good other alternatives. You can have a lower entry cost. Don't need as much money to invest into property if you're happy with this type of exposure. And under the hood, these things, what they do is they pool your money with other investors, and then they go and invest that. So it'd be with a fund manager, for example. They then take all the investors' money, and they will then go and invest in a range of real estate assets. So you might have one particular manager that focuses highly on office buildings. You might have a very diversified manager that does a mix of all of them. And some might focus solely on Australia, some might be global. REITs, so real estate investment trusts, we call them REITs. They're listed on the stock exchange, but both REITs and managed funds are pretty liquid generally. And that's one of the advantages of them. So it makes property as part of your overall portfolio accessible and provides a bit more liquidity than investing in property directly. And a good point to make here is also that your super funds, most of our supers, if we're in industry or retail options, will likely have property exposure in your super already. So you might already be a property investor and not even know it. Over to you, Elina.
Thanks, Kelly. So I just want to talk a bit more with relation to depreciation as a tax benefit. So depreciation provides an annual tax deduction for the declining value of investment property assets. There's no out-of-pocket expense. Thanks, Kelly. No out-of-pocket expense is required to claim these deductions. These deductions reduce taxable income and improve the cash flow and enhance overall investment returns. From a year-on-year basis, depreciation continues to deliver value annually, even when the property is fully paid off, and it's a strategic tool for long-term wealth planning. So an example of that, of how it plays out in real terms, is you've purchased an investment property, so you've funded that by borrowings, 80% borrowings, you've had a 10%, 20% deposit on it. Let's just use an example. The property costs $500,000, and you've funded 100,000 of that, and you've borrowed 400,000 of that. So then year one, if this is, and we'll talk through the particular rules on some of the depreciation that can be claimed, but you've paid for that property up front. You've got an asset there. Now you can claim a percentage of that as a deduction over the life of the either asset that you're holding or the property itself. So there's no cash going out of your pocket year on year, but you are allowed to claim a tax deduction. So I'll just, and this in turn, next is it, Kelly, do you mind just flicking to the next slide? So the two kinds of depreciation that can be claimed are capital works deduction, that's Division 43, and it applies to the building itself. So it's a permanent fixed asset, it's the walls, roof, plumbing, etc. It's the actual building. There's a percentage that can be claimed at 2.5% per year over 40 years from the construction completion date. And that's available for both old and new properties and provides construction began, provided of course construction began after certain dates. The plants and equipment depreciation, Division 40, now that's where, I'd say recently, but in 2017 the laws changed with relation to that. From 2017 you can only claim a depreciation on new plant and equipment. So that's such things as appliances, dishwashers, stoves, carpets, blinds, and furniture. Each item has its own effective life determined by the ATO, but you can only claim them on new properties. So if they're completely new, you purchase a property and it's a new property and they're all new, then you can claim a portion of them. However, if you purchase an established property and they exist in the property, you can no longer claim a deduction for that portion of the holistic asset, essentially, unless you purchase and install them after the property is income producing. So it's then a depreciation on a new asset. Now, to be able to claim these deductions, what we usually suggest is obtaining a quantity surveyor report. This is an external professional who prepares a holistic report. It's usually 50, 60 pages long, and it goes through the entire asset list, the entire property, and it will give you a breakdown of the capital works deductions on the building and the plant and equipment deductions. The capital work deductions are usually in a straight line kind of method, and the plant and equipment decline in value, but it can still be used a straight line method for that as well. This report essentially gives you the figure, so it eliminates any need for yourself or your tax accountant to calculate it, which can be timely and therefore costly. An upfront report from a quantity surveyor provides the figures, and those figures are valid and relevant for years to come, and it's just essentially using the figure provided as a tax deduction in your tax return. And a quantity surveyor report typically costs anywhere between $300 and $600, and we certainly do see there's a benefit in that. There's quite a good small investment for the long-term benefit, and set figures of depreciation. They are non-cash expenditure. You haven't paid for them. You bought the property up front, paid for the quantity surveyor report, a couple of $100, and thereafter you can claim a deduction in your tax return against other income, and this supports the negative gearing aspect of it.
Could I ask a question, Elina?
Sure.
Without warning, sorry. How does depreciation impact my cost base, being what I paid for it and the figure that we work out for capital gains tax later?
So it's not going to. So this is an important question of timing. Thanks for asking, Kelly. So if you've purchased the property, and let's just use the $500,000 example, and You're then claiming depreciation, so you over the next 10 years. Then when you come to sell the property, you can no longer claim your cost base to be $500,000. You need to add back the portions that you've claimed over the life of ownership, essentially meaning you can't double dip. So if you're claiming it over the life of ownership, as a, you can't then claim the full amount as the cost base when you ultimately sell. So your capital gains at the end when you do sell will be greater, and it does depend on the figures that you are depreciating over the ownership period. But this all also plays part in the planning. Part of the purpose of holding the property, if you need the deduction up front, and it's having a positive impact on your everyday cash flow, and that cash flow is needed, and you need it to essentially fund mortgage repayments, etc. Then that's where the benefit lies. But it is something that is certainly to be considered over the life of the ownership, whether you claim it year on year, a portion, or whether you don't claim it and you maintain your $500,000 cost base, and when you ultimately sell, that's the cost base that contributes to the capital gains calculation.
Amazing. So really important to involve your accountant in your discussions with investment properties along the
Yeah,
journey.
yeah, yeah. And this is often a piece that is not understood fully, the concept of adding it back when the property is sold. So essentially, it's important to know you can't get a deduction twice. So you've bought it and then you're claiming it as a deduction either against income year on year or against the capital when you sell. Might just move on to the next slide if you don't mind, Kelly. Negative gearing versus positive gearing. So gearing refers to borrowing to invest. In the context of our discussion today, it is using a loan to buy a property. So positive gearing is an investment is positively geared when the rental income exceeds all expenses. So you've got a net positive cash in your pocket after paying all loan, interest, maintenance, insurance rates, and any other property expenses you have. That cash, positive cash that you have at the end of the day, adds to your taxable income, and you need to pay tax on that. So it's added to the total taxable income that you have from other sources. Pros of positive gearing is the positive cash flow. So you've got the additional income, less sensitivity to interest rate rises. So if you're positively geared, and you're not necessarily 100% in need of every dollar that you receive to live from, then the impact of interest rate rises is not going to have such a significant impact. And it can improve borrowing capacity for lending as well. And these are some of the things that a broker will talk through when looking to finance and or refinance or potentially invest in an additional property. Cons of positive gearing, obviously, it's not as attractive so you're not using it as a perspective of reducing your tax. You have to pay tax on that income. Negative gearing is an investor is negative gearing when the rental income is less than the expenses, resulting in a net loss. So essentially, example, your rental income is $50,000 a year. Your rental expenses are $60,000 a year, including interest, including depreciation, and you've got a net loss there of $10,000, and that $10,000 adds to your taxable income, reducing your taxable income, and therefore reducing your tax liability. Can often result in quite significant refunds for individuals. Noting there that when I said the 60,000 expenses includes depreciation, that might not have actually been a cash expense that you've paid. Um, as in, it's definitely not a cash expense, the depreciation portion, but the total cash expenses from that 60,000 property costs or property expenditure might be 50,000 in cash. So from a cash perspective there, you might actually break even. Your rental return is 50,000, cash rental expenses are 50,000, depreciation is $10,000. So you then have total rental expenditure of $60,000 and the $10,000 written against other taxable income. But from a cash perspective, you're neutral. Um, Pros of positive gearing, potential tax benefits, as I've just said, and cons of positive gearing, you need to be able to fund the shortfall from your personal cash flow um, if it's not attributed to things such as the depreciation. So interest rates is a significant one. If interest rates rise and you're right at the line, an interest rate rise might push you over. So this needs to form part of your planning around negative gearing. Um, so if it's going to impact your cash flow and you're going to struggle, that needs to be part of the planning. But interest rate variations do have a significant impact on the final plan and position where you will be.
I might just quickly acknowledge the typo on the right-hand side of the screen. I've written pros of positive gearing and cons of positive gearing on the negative gearing column. So apologies for the typo. I will amend that before we send the slides out to everyone.
Thanks, Kelly.
Maybe we'll move on to the benefits of investment properties now. So I know there's a lot of words on the screen, but we'll just work our way through them. And there's I think 10 points here. Maybe the list could be longer, but we've just sort of tried to. I think we've got 10 benefits and 10 drawbacks. Try to keep it like a nice, even, balanced point of view. So the first being property is a tangible asset. Like we talked about at the start, I think investment properties are quite popular because you can see and touch it. You can stand on it. It's a much easier to understand. I think people like the idea, especially if it's a property that you buy that's near where you live. You can drive past it and see it. So that's one of the benefits of investment properties. Banks consider property as safer than shares, so they're often prepared to lend you more money and generally at a lower interest rate. As long as you don't default on the loan, there are no margin calls. So I think in previous times there have been times of lending at high interest rates and then moved into a period of market lows and people have had margin calls and have to sell the shares or have to fund the difference in the loan from their personal cash flow. That typically doesn't happen so much with property investments. I think that's partly because with property you don't know the value of it on a day-to-day basis. So generally, if we're going through a lull in a property cycle, the bank's not really going to come trying to make you cover the difference. Inner city land is a finite resource. So we talked earlier about the demand, and especially in the inner capital cities, there's going to be there's only so much land available in the capital city. So that's why demand is likely to continue to grow over time. Not to say that other properties or other areas won't grow also. So I think during COVID, we saw a boom in the more regional property values. But as people move towards going back into the offices, that's tending to change back to inner city prices going back up. Property, generally, it's seen as something that's more stable, and over time, if we were to map out those asset classes over time, the journey along the way, property is generally a bit more stable, so it's not as volatile, but the returns are generally on the more conservative side also. uh, new properties can provide significant tax benefits. So Elina talked a lot about the depreciation side, and that's definitely true for the newer properties. You can use property as a foundation for other investment opportunities. So you can use your home, your principal residence, to borrow against and go and buy other investment opportunities. You can build up equity in your investment properties also. So a lot of discussion is held around, do I start a property portfolio? So uh, buying properties, building up the equity over time, and then using the equity in that to just keep buying other properties. You can also borrow against your properties to invest in other asset classes. You can do share investing or a diversified portfolio. But the main thing is it can be a good foundation. Uh, you can control and improve the asset over time. So we won't really cover off today people who go in, flip properties, but there can be people who do it with that view to development opportunities. They see an old house on a nice big block of land, go in, maybe knock it down and rebuild with duplexes. I'm sure many people around or joining in today are aware of all the duplexes being built. Or you go in to an older house, do some renovations and add value, and then sell for a profit down the track. Property provides an investment discipline. So, because there is that loan associated generally with an investment property, you're paying that back over time. So, that's a good disciplined approach. And then Australia has a growing population. So, there's housing shortages in key areas. I think the other day they came out with the approval for homes is 50,000 when we were targeting 75,000. So there's not enough houses being built for the people for the demand. So that supports property prices. Did you want to add anything to the benefits, Elina?
Yeah, just on that, the clearly the demand is really pushing the value of investment properties up, and I have with the ability to use the existing investments and draw down on equity to purchase more. I've seen it over a number of years and a number of times. Individuals have built up significant wealth by leveraging their existing property. It goes up in capital value. Then um, and the banks are very risk prone, but the banks are lending against it. So essentially, equity in currently owned property is funding the deposit on the new property, and this is just quite consistent growth. But the key piece in that is to have made sure that you've spoken to the right professionals and you've sourced the appropriate property. Not all properties, Kelly will cover off in the um, drawbacks, but not all properties do provide that capital growth. And so it is absolutely key that if this is a strategy and it is a wealth creation strategy that you have, is to ensure that you are sourcing the right properties in the right areas with the growth potential, and are appropriately managing the risks and variables around that. But yeah, there's a lot of positives that can become from property investments, but there's also some drawbacks as well.
Good segue. We'll get onto those drawbacks. So one of the major things with property is that it is slow to transact. So some property transactions, I mean, you can potentially negotiate a shorter settlement period, but generally you're looking at 1 to 3 months or sometimes even longer to settle a transaction. There are a lot of different people involved. So you'll have conveyancers, mortgage brokers, the vendors, the purchasers, the real estate agents. There's lots of different people with different agendas. So, as we said earlier, the real estate agents really on the seller side and the buyer's agents on the buyer side. So, I guess it depends on where you sit in the transaction. I guess it's just being aware of everyone's different agendas and having to juggle all of those different people. It's expensive to transact. So purchasing property, you've got lots of costs. So stamp duty, and we're not referring to first homeowners today. We're talking about people buying properties for investment. So there's stamp duty. I know that's technically called transfer duty, but it's just typically historically been called stamp duty. So I keep referring to it as that. You've got conveyancing fees, real estate or buyer's agent fees, and generally for property, you need to have a large amount of capital available to do the purchase. So that's just something to be aware of. So purchasing the property can be expensive, but then also the owning of the property, the ongoing costs, that can also be expensive. So depending on the ownership structure and all of these things, and the type of property, you've got land tax, rates, maintenance, water, insurance, strata. They're all going to vary depending on the different property that you own. And yes, so a portion of these are going to be tax deductible. I don't think land tax is deductible, but maybe Elina can comment on that.
It is.
It is?
It is, yeah.
Okay. Well, good to cover that off. So yeah, even if there's something that's tax deductible, you still need to outlay these costs before you can claim them as a tax deduction. So they all need to be factored into the cash flow planning side of things. Leaning into cash flow planning, if you ever need capital, if you need funding, if you're relying on the income from your investment properties to fund living, and you don't have a tenant, you can't sell a portion of the property. So I often say you can't sell the bathroom, you can't sell the kitchen. So if you weren't in need of capital, you might have, and you've got a couple of investment properties, and this is funding retirement, you might have to consider selling one or multiple properties in your portfolio. And then we go back to that first point, that property is slow to transact. So it can cause issues with funding living expenses. And I think this is really important, partly from a wealth accumulation phase perspective, as we're building capital. If there's a period of time where maybe we've gone from 2 incomes to 1 income, we've got young kids or things like that, or maybe one person's made redundant, how's it going to impact our strategy if we don't have a tenant for a period of time and we need some money? But then also from the retirement phase of life, we do see clients with self-managed super funds that have got a couple of properties in them, and it gets to a point where the client's living off the self-managed super fund to fund living expenses, but the properties aren't generating enough income. So then it comes up with other compliance issues that weren't anticipated. So they have to consider selling. So you've got your minimum pension that you have to take out. So you've got not able to fund living expenses, but then also got compliance issues in that I can't meet my minimum pension payment in my self-managed super fund. Just things to consider. So difficult to track the return of your investment. As I said before, a property, we don't know the value of the property on a day-to-day basis. With shares and funds, there's publicly available information. Shares, it's on a stock exchange. You can see the value of the share price and how it fluctuates minute by minute even. But with property, you really only know the value at the time you get it valued or when you go to sell it. So it's difficult to track the return and the performance of the asset over time. Kind of covered this one, but there could be periods with no tenant, which you'll have a reduced income. However, you still need to service the loan repayments. So that's a really important aspect. If you've got a loan against the property, you still have to fund that cash flow from somewhere. Lender's mortgage insurance, or LMI. So if you're paying or purchasing a property with less than 20% deposit, you need to take out LMI, but that doesn't protect you. That protects the bank. For some portfolios, we see there can be a lack of diversification because a lot of capital is invested in one property. Being from the financial advisor perspective, we really like diversification and not having all your eggs in one basket. And And there are legislation risks around changes to negative gearing and bank lending practices. I guess that's probably uh, the same with a lot of things that we go, and people probably have a view around superannuation and risks around legislative changes. And we can only really work with the rules at the time that we're making decisions and going into things. But there, it's just worthwhile noting that things could change in the future that might change our approach. Did you want to add anything and then move into your case studies, Elina?
Um, no, I think you've covered it off very, very well. Just to the point with relation to legislative risks re negative gearing. I mean, that's been a hot topic for many years now. Um, a few years back, it was taken to the election and didn't get through. A suggestion of change to negative gearing. Um, I think there's a huge, with the potential of change, there needs to be a huge amount of modelling and thought put into that if there were ever going to be a change, because I think that would have a significant impact on the property market on a number of levels, um, just the property market. So my personal view is that that's not potentially going to happen in the next short time, but of course, um, there's always talk, and we have to be aware of what may or may not happen. But on negative gearing, I've got a few case studies here. So this, I just thought I'd run through the a few case studies of potentially what a investment property looks like from negative gearing perspective, the tax benefits, and also the cash in hand out figures at the end of the day. So just note, it looks a bit like an Excel document, but I've just put that in there in ways so that I can direct you to certain columns and rows, as there's a lot of numbers on this slide. So I've just put in projections on potential properties. So let's just, these are examples, and the figures here are suggested on a property cost of 1 million, projection 1, a property cost of 800,000, projection 2, property cost of 600 and 400. And now I've got to always consider, as McKerrell said previously, with relation to stamp duty and transfer costs, legals, etc. So there's additional costs. So you purchase property, but there's always going to be additional costs, and specifically if it's investment property, the stamp duty is going to be one of them. Now, here in these projections, I haven't considered LMI, and therefore I've calculated the projections on the basis of a 20% deposit, so borrowings on 80%. Now, if we look at an projection 1, for example, the $1 million property, and I've got interest rate in there at 4%, and so sorry, I did have more than 6% as well. So I've got 4% is rather low in today's market, but I generally sit down with my clients and run through this with a number of different views and a number of different models and plans of the current and potential future. Where if we say from $1 million perspective, the rental return on that is $800 a week, 41,000 a year. We've got our interest deduction, which is 4%, calculated at 4%, 80% borrowings. We've got rates, water, insurance, maintenance, depreciation. Of row 22, it's a non-cash expense. It's a deduction, as we spoke about. Land tax and property agent fees. So total outgoings of 57,400 and a net capital, a net rental loss of 15,804 on that. Now, just noting that these are just projections; these are not set in stone. Every property has their own costs associated. But these are relatively standard, and it is looking at a standalone property, not a unit or an apartment in a high rise where there are other costs such as strata or body corporate, which is significant also. Um, so if you just run through those figures, they're looking from 1 through to 4 perspective, and 4 I've listed there as a property quite low value for purchase. These properties do exist in different areas of Australia. So when considering for the long-term holding strategy, you can't be, you have to consider and that's what buyers agents can support. Just at low entry point, potentially an easier step into the market. There can still be significant capital growth. You're not necessarily tying up all one asset. So now if we jump over to the next slide, Kelly, and we look at negative gearing here. So this is this is the cash outflow perspective, and I'll just look at scenario 1. Now I know in the previous slide it did have a modelling there at 4% interest, but this one is at 6% interest. So it's more realistic in today's market of what the actual interest rate is, and to give you an understanding of where your end of cash position might be and the outgoings. So if you look at the blue slides, they are looking at blue rows figures pre, and then the green ones after we've included various rental property, and then the yellow shows the tax saving that you will have versus having the rental property versus not having the rental property. And I've just highlighted the non-cash depreciation because that needs to be added back. You're claiming it as a tax when you're calculating from a tax perspective. You're not paying that when you're looking at it from a cash in hand. So let's just look at scenario 1 through to scenario 6. The scenarios are based on individual taxable income. So if an individual has 500, 250, 200, 150k, 100, even 80,000. Free rental properties. So wherever you might look at the perspective from your personal income perspective, then you've got your tax calculated on that income pre rental property, Medicare, and after tax. And I haven't calculated all very small amounts. This is just a very broad summary. But your net cash in hand figures after tax will be there on. Kelly, do you mind just muting your mic? It's just for a moment. Thank you. Then we've got annual rental return or net rental loss in this instance. This is negative gearing. Now, as I said, this scenario is based on everything the same as in the previous slide, but with 6% interest rate. So the outgoings and the rental loss is greater than what was there in the previous slide. So for a $1 million property, we have a rental loss of 32,000 here, and that's on row 13. Then what we do is we calculate the taxable income after we've added the rental loss. So now our taxable income is reduced. That's there on row 15, and then we calculate the tax payable on the now income and various Medicare. Now to add back, then we add back the depreciation portion that was in that calculation. It's $8,000, and that was quite conservative. If you're purchasing a new property, the depreciation can be significantly higher than $8,000. It can be less if you're purchasing a pre-existing property. and you're not able to claim deductions for fixtures that are not new. But there I've got the estimate there at $8,000. So net cash position after a rental property loss is put through is $289,000. So if you look at that, then go down to the summary of it, net cash at pre-property at row 24, rental income, then rental deductions, then add back the non-cash ones, then you've got a tax saving there of $15,000 if your income was $500,000, $15,000 also if your income was $250,000. That is because you've already capped out the lower tax brackets, so you're now at the top end. If you looking at the lower scenarios where your income is at 150 or 100,000, the tax saving is less, and the reason is because you're on a lower tax bracket. Your tax bracket is lower than the at that 500 and 250. They're capped out at the highest marginal tax rate. So where you're paying a lower tax percentage, you have a smaller tax saving. So net position after property, and then row 32, net annual cash inflow outflow. So even though we saw up there on row 13 that there was a rental loss of $32,000, our actual out of pocket is $9,000 for a $500,000 rental property. Sorry, taxable income pre-rental property. And in scenario 4, for example, if your income is 150, your net out of pocket after all of that is $13,000. So it's not that's the benefit that we get with the negative gearing, and specifically with being able to claim a deduction for depreciation, which is a non-cash expense. If we look at case study, if we just move down to the next page, Kelly. So this one was projections done on a rental property of 600,000. So this was rental property projections there on a cost base of 600,000 with the various costs in there as well. Everything is the same as the previous slide. It's just that the rental loss was less. And as we can see, then the net out of pocket at the end of the day there on row 32 is also less out of pocket, and our tax savings have been less. So I'll just give you a moment to take all that in.
Unfortunately, we're a little over time now.
Oh, yep, sorry. So let's just move on to the next slide very quickly, and then we'll wrap up. So Kelly, if you don't mind just jumping down to the next slide. Here where my modelling at the top showed a 4% interest rate. This is, everything's the same. Rental property, the $1 million rental property, but with a 4% interest rate. If you just draw your attention to the row at the bottom, 32, net cash outflow, inflow, outflows, flow. So an out-of-pocket amount for investment property of the $1 million with a 4% interest rate, it makes a significant difference in your end of year cash outflow. So I put that in to consider. So also, if the interest rate were to increase, it would have a reverse impact of cash outflow out of pocket. And sorry, we are out of time. So but these are just a number of the things that I do when I'm sitting down with clients in modelling from this perspective to understand the cash inflow, outflow, tax saving, and a bunch of different considerations and property costs that will be involved. This is all very general, none of it is specific, and each individual property has their own costs and things to consider. So this is by no means set in stone with relation to exactly a $1 million property. It's just an example. And with that, Kelly, I
Should
might
I?
just hand it to you. Yeah.
Beautiful. Thanks, Selena. I'm sure everyone can see that this is such a big topic. There's a lot that could be unpacked even further. And Elina is very passionate about this topic. She works very hard for her clients in preparing all of these scenarios. And um, if you need any assistance, feel free to reach out to her. And if you'd like a financial advisor perspective, happy to have you reach out to me also. For the people that did pre-register questions, or if you've submitted throughout the session, apologies we didn't get to answer them today, but we will reach out to you individually post the webinar in due course. So I just want to say thank you to Elina for her contribution today, and for all of her time, and thank you to everyone for making the time to join the webinar today. I hope you enjoyed it. Please feel free to reach out to us if you have any questions. Yeah, thank you everyone.
Thanks, everybody.